Hello, everybody. Hi, Kevin. How are you? Let's have a great week. Welcome to FACE. I just want to remind everyone next week at this time, hi, Jim, we'll be starting an hour early. It's going to be FACE daylight time. So we're making a 1 hour adjustment. If you show up at this time next Monday, you'll be in time for the interview rather than all the rich content that happens for the first hour of all of our sessions. Hello, John, how are you? So give me a Y if you're aware of it. Next Monday, we will be starting 1 hour earlier. Okay, I know it helps a lot of people in Europe, especially helps our Asian subscribers, especially guys and ladies in Australia that stay up till midnight to be here. Okay, Jinx, you owe me a Coke, Anthony. All right, so I'd like to start off with USD MEX, which is something that Blake featured down here last week, and just point out the difference. So Blake shared this, that it looked like we were going to come out of here. So the difference between what happens in the room and what happens with our subscribers is this. So Blake's going to talk about something evolving, but subscribers are going to get entries, which ended up being the low, very close to the low at 1754 to 57. We never got to targets, but knowing Blake, I'm sure that he took something off. He's a trader, not an investor. So that was another nice trade. The DAX is still working. So some great trades from the CEO of ForexAnalytix, Blake Morrow. Hope you're able to take care of it. The difference is you really need, unless you're a pro, need to know what the entries and exits are on these. Okay, so he featured it at least a couple days. I know Steve Volge was looking at the falling wedge there as well. Looks like it came out of the hole. So another great call by ForexAnalytix on the pattern in play. So let's get to the euro, because there is something happening in the euro that hasn't happened in a while. Also want to make clear that any trading suggestions that I make here in the room are really not a reflection of the service. This is kind of a room thing. Blake has asked me to share my ideas during our session, but they don't show up on the letter. So whatever I do, good, bad, ugly, it's not a reflection on the service. But as you can see, we're starting to get some pretty good divergence here. To me, it looks like a 1, 2, and this may be 3. You can't rule out one more push up, but to me, it's really, really, really late to be long euro. And I think Blake was saying that'd be reasonable for us to possibly see 113.5 again. So the 4 hour, there's still plenty of mo, but on the 1 hour, just want to look at the daily here. Yeah, daily's trying to confirm up here, getting a little bit of a reversal day, but here you go. This was a pretty big breakout over 113, 113.5. So in conjunction with that, I believe last week I used the term gift in regards to euro yen when the euro was exploding, and said that anything at 130 or better was a gift short. So it was here. We went to 30.5. So if you took it even at 130, you have 90 pips, 80 pips. Anyone that's been following me for any length of time knows that I'm a proponent of taking partial profits anytime you're up a lot less than 100 pips or 90 pips. Still feel that there's some more downside, and the downside may start to come from the euro rather than yen weakness. Yen is getting into a support zone. So if you took the trade last week, I recommend you ring the register on 50%. Give me a Y if you understand it. And that's money management. There could be more left. And now you could think about trailing stops on the remainder. The obvious place would be above 30.5, but if you want to tighten it up, there's probably something even tighter than that. Maybe back over 129.80 is all I'd risk here, so you'd be in a profit position even if the market took off and went to above 129.80. Everyone with me on the money management strategy on the sale from 130 to down here. At one point you had 87, close to 113 pips on this candle. And to start to be careful with longs, and there might be a counter trend short coming up here in the euro, even the euro pound, which had a blow off last week. This was a pretty classic 1, 2, 3 right here. Everyone see this? Here's drive 1, here's drive 2, and here's 3. The 3 didn't even get close to the previous high on the RSI down here. So if we're going to continue to correct in euro pound, and we came very close to some of the long-term objectives that Nicola Duke had up near 90. In fact, we got there. So I'd be pretty careful about longs here. And if we do begin to correct here, this favors euro shorts over cable shorts. In fact, Nick has a pattern in play. Subscribers, check it out on the pound. And remember, next week, 1 hour early, have a returning guest. Mark Newton will be with us at the top of the hour. Mark's a CNBC contributor. In fact, when Mark was with us and I asked him about stock indices, he was very sanguine about them, saying that they won't run into any trouble until the July time frame. So here we are, we're in July. It's going to be great to see Mark's update and what kind of problems. He published an article on See It Market, so I'm going to ask him about that. And with that being said, I'm going to toss the ball. We're only a few weeks away from preseason NFL football. So this is our preseason, and I'm lateraling the ball to you, Blake. How are you, my friend?
Dale.
How's it going, buddy?
Good. So what are you going to do without the Chargers over there in San Diego?
I don't know. I'm a long-term suffering Bear fan.
Oh, okay.
But I watch games on TV anyway, and I'll still watch them on TV. The Chargers have been a heartbreak for San Diego fans forever anyway. But
yeah.
you have a team. You have the Cardinals are a pretty good team.
They're all right. We don't have a quarterback. That's the problem. Is we don't have we have Palmer, but he could get hurt at any moment. So it's
he's getting up there in age too. He better learn how to trade FX if they keep taking him down out of the pocket. Do you go to any of the Sun Devil games, Blake? I used to go to a lot of Devil games.
ASU games, no, because they're too crazy. They're really. I mean, I haven't for years. They're just. I'm too. I should.
It's too hot too. Yeah, I mean, I'd go to games. It'd be a night game, and it would be 99, 100 degrees in the stand.
Yeah, it's still a little warm to be out there, but getting to FX, because I know a lot of people could care less about American football. Actually, I would say probably at least 75, if not 80% of our listeners could really care less. There's not.
Yeah, they have a different definition of football. Most of those people.
Right, exactly.
You mean the melon ball, correct?
Right, melon ball, exactly. See, this is the problem with Europeans.
Good morning, by the way, everybody.
Oh, nice. So we could get a breakdown in euro. Do you think it could be the euro if we break this blue line that's going to take it down, or continued yen weakness?
Well, first of all, I think it's continued yen weakness because the dollar yen is below the 200-day moving average. It's trading really heavy despite the rally that we've seen in equities. So I actually think it's going to be more yen strength. The euro is still very strong. I mean, I think you are correct in your assessment as far as, I don't know if this is the right time to be long the euro dollar, but I don't think I'd want to be short the euro dollar. Maybe the euro something else might be a play like the euro yen, but I don't know about the euro dollar. I think pullbacks are going to be fairly limited. I mean, I just read an article from a guy that I read every day, who was talking about the kind of what I briefly mentioned on this week's week ahead video. I mean, Mario Draghi, he had, I mean, that the ECB meeting was anything but hawkish. It was as dovish as they could be. And the
Euro, kitchen sink at it, man.
He really did, and I mean, the euro is still extremely strong, and you would think after that press conference, or even after, like, let's say, a couple of days later, here we are, that the euro might start seeing some weakness, but the euro is still extremely buoyant at this point. So, if you were shorting the euro, I mean, you got to be a little nervous just being on the short side of the euro in general, and so, I look at it as, well, whoever's short is, at a risk at any point for it to push higher. If anybody, is actually short the euro, but I would like to see a pullback. I would like to see a pullback so I could reload. I was hoping for a move back down here to like 114.50, 115, and I'll probably have to just redraw that a little bit here. These are drawings from last week, but we haven't seen any type of pullback really. The dollar's trying to find some support down here. I mean, but keep in mind the dollar index still looks really bearish. So, I look around and it's like, I don't know what to do here, especially with some of the majors. I look at the pound, it's like, okay, what do I do with the cable here? What do I do with the euro? And the only thing I really like to do is buy it, but I don't want to buy it up here. I buy it down here if we can get down there, but I just don't know if we're going to get there. You look at the DAX. The DAX is extremely weak. It's reflecting the strength of the euro is really weighing on the DAX right now.
Are we close to the pip target on that call you made a few weeks ago? I think we're pretty close.
We're getting close. I mean, I think it's 12,000 if I'm not mistaken. 12,000 basically. Okay. So I mean, we're getting there. I mean, the 38% retracement is going to come in shy of that. We got some support down here at 12,000. So I mean, it looks entirely possible. But as of right now, the DAX is breaking lower, and you have the S&P and the Nasdaq, which are trading. Let's go over, take a look at the equity markets here. I mean, they bounced up this morning, but they're trading somewhat heavy. There's the S&P, the Nasdaq is down a couple. So I'm more interested to see what happens in equities right now. I'm not super interested in what's happening in currencies at the moment, because I just don't really see much. The Aussie's still extremely strong. I picked up the Aussie New Zealand last week at the 50% retracement. Well, I bought it like this zone. You can see this zone right here. I bought it at 106, like 20 like 2, and I sold it overnight at 70. I'm already out. I had a limit order to sell it. And I already got out. I'd like to buy it again on a dip, but I'm looking at some of these, these cross rates and trying to figure out maybe if there's something to do over here, because I don't know what to do with the majors right now. The Kiwis, the Kiwi broke out. It broke higher. You can see this, major triangle that we've broken out of. So I mean, you look at the Aussie, you look at the Kiwi, you look at the Canadians broken down. You look at, the pound isn't quite there yet, but you see all the dollar weakness coming through the market. So it's hard for me to go, all right, well, why is the euro going to stop here? Why should I just short the euro dollar? I just don't know if that's the right trade at the moment, because the euro is, I mean, the dollar is really just kind of breaking down against everything, you know, so it's like, I don't know if I'd really want to look at the euro dollar and try to short it right now. I just don't know if that's the right trade. So.
Yeah, it's going to be, I'm looking forward to talking to Mark Newton about the dollar, because, you know, when we had Raul Paul, you know, he's still a long-term dollar bull, and he was talking about a DeMark indicator he was using, and it still could be constructive after it takes out 92-ish. And even Grega, I think, had a nice count where he was expecting a flush under that 92 low and then a pretty good rally. So we're not there yet.
No, we're not there yet. And is it that entirely possible? And I think that's what I, you know, as I pointed out in this week's video, I mean, I think that 92 is doable in the dollar index, and you know, just because it's going to shake out all of these longs, and I wouldn't be surprised to see us, you know, maybe 92, maybe come back down to 90 and see some sort of bounce, but it doesn't look like it's there yet, and so you know, because if the dollar index goes from where we're at right now, which is basically 94, and we go down to 92 or 90, I mean, that puts the euro at 120 at least. So, you know, again,
Sentiment remains extreme.
The what?
Sentiment remains extreme. So at some point when we get a reversal, you know, everybody's going to be completely.
What's a DSI in it, Steve? Euro or dollar?
Something extreme. And oh no, I'm talking about the DXY. The DSI.
Okay, can't hear you.
Like at 8, but it has been very, very low for a big period of time. So now everybody's getting used to selling the dollar, and you know, I believe that, you know, this kind of unraveling can start when we see some kind of a rebound, and everybody still maintains, you know, an approach that, okay, come on, you know, any rebound in the DXY is, you know, sellable, and that doesn't work. That's what I think, Blake. What do you think?
Any economic reports that could be, you know, light the fuse for a correction in the dollar this week?
Well, yeah, we have GDP at the end of the week.
Okay.
So,
FOMC and then GDP.
Yeah, and we have the FOMC. You're right, Stelios, and actually, but the FOMC, it's unfortunately it's just a statement. So we don't have. You know, it's just going to be it's going to be a statement. There's nothing more than that, and no one's expecting the Fed to raise rates. So, you know, how they tweak the language might influence the dollar a little bit. But I actually think more of the advanced GDP at the end of the week is going to be the market mover, not so much the Fed. I'm actually going to go to I got invited to go to a baseball game on Fed Day, and I'm like, yeah, I always lose money on Fed Day, so it's probably not a bad idea to go.
You two guys that you're American, and you watch politics, you know, closer there. Any idea what to expect this year with the debt ceiling? How are things progressing on that? And because, you know, that has the potential of creating some volatility as well at some point.
Yeah, when is that, Steve? In September this year?
I don't know if that's in September or not.
I think it's before the end of the year. I think it's in the fall. You know, and I think that President Trump has made statements that if he doesn't get anything done by then, you know, it's possible that, you know, there could be a problem with that, and maybe Standard & Poor's comes in and downgrades debt again. That would be a pretty negative catalyst if that happens, Steve.
Well, you know, and the thing is I don't think he's afraid to default on our debt. So that's a scary thing too. If you're dealing with the dollar specifically, you know, it could be concerning, but I think we have to worry about that as September comes near.
Well, if the U.S. government does that, Blake, can we do that with our credit cards?
I guess. I guess that's how it works. I mean, You know, maybe it's more Me Too money, and that's what everybody's doing. That's what everybody's doing with their cars right now. I think everybody with their all these auto loans out there are just leaving their cars outside to be hauled off now. Yeah.
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 Emilio Estevez is real busy.
Right, exactly.
He's the repo man.
The repo man, the old repo man. You know what's extremely bearish is the dollar Canadian. The dollar Canadian's hitting new lows right now, and it's just extremely. I mean, we're extreme here, but you know we could reach 124.70, which is you can see right here is the spike low. Spike low comes in at 124. Let me make sure that's actually 124.60. So we could actually hit 124.60. We could get down there, maybe even lower today. You know, this dollar Canadian is extremely weak. So, but that
someone tweeted me, Blake, and said that Canada's trading like oil's going to 100, and that it's going to be a rude awakening when it's trading 35.
Well.
It didn't matter before, but maybe now, because it's been so depressed and punished, that I think we didn't quite achieve the upside targets that Grega and Nick had, about $49 in crude. But maybe if there is another crude break after that, that could be the catalyst for a correction anyway.
The Canadian crude oil correlation is really broken a lot. You know, as of here, I mean, you can. You know, here's the dollar Canadian, right? Let's compare that to.
That was a tell up there at 38. Crude was getting smashed and Canada couldn't rally. That was really a nice market tell.
Yeah, I mean, you can really see this the breakdown and the correlations just this last, you know. I guess it's going to be for the last several months. You know, the dollar Canadian has come down, but crude has also come down as well. So I don't know how sticky that correlation is going to be. But it does seem that, like, if crude oil does get a bounce, it does weigh a little bit on Canadian, meaning the Canadian will strengthen. But we haven't seen crude oil weaken and the Canadian weaken. That correlation hasn't been around for a while.
Well, maybe the only correlation that's still going to hold, and we haven't had a chance to see it, would be risk off to create a bounce in Canada.
Yeah, that could be. The dollar Canadian and volatility tend to go hand in hand a little bit, so that could possibly be the case. But we'll see. You know, we'll see about that. We haven't seen it yet. But because we haven't seen a spike up in volatility, but volatility, and that's one thing that I think that you know, we're at historic lows in volatility, so to see the volatility bounce a little bit isn't surprising. I think volatility from these levels is a screaming buy. I mean, just, you know, I think over the next month or two, you're going to get these spikes in volatility up into the teens that'll pay you. You know, you just have to be very careful how you play it, because if you're using those like leverage ETFs, you know, it's going to take a lot of your profits by doing that. So you got to be, you know, you got to think about how you want to play it, you know, volatility long play. But I think volatility is a good place to be on the long side of volatility. You know, because any type of little shock is going to send
the contango in this product has chopped up plenty of people during the past few years, and you know that's why plenty of them have stopped using you know, VIX for protection, and that, in my opinion, Blake, adds to the market complacency a lot. I mean, when at some point we get a big reversal, there's going to be a lot of people that don't actually have downside protection.
Yeah, that's a great point, Steve. And because right now, and how many people are playing VIX to the short side too? That's a huge position of the market. You know, everybody just sells volatility every day, and so that's the really big risk is a push up in volatility in the coming weeks and months ahead, in my opinion.
Thank you,
So
Blake.
Steve, yeah, no problem. I'm gonna pass it over to you guys for the open. Hopefully, Steve, you got something that you're looking at. And guys and gals, do not forget that next week we start an hour earlier. We're going to be pushing the webinars back up an hour. This way we can cover some of the breaking news that comes out. It's going to be better for European and Asian traders, and probably North American traders as well. So we think it's going to be better for everybody. Consensus has shown us from our viewers that earlier webinar is going to be good. Also, one other thing I wanted to point out is for those of you that have returned my email about comments about adding tickers to ForexAnalytix, in the future. I appreciate your feedback. For those of you that want to get your feedback in, I'm bmorrow at ForexAnalytix. That's MORROW. Make sure you get an email into me. Thank you very much. And Steve, I'm going to pass it over to you.
Oh, and Blake, after your tweet of that wild animal that wild person in the wild wearing an ForexAnalytix t-shirt, there's big demand coming for that product now. So
might have to
order
make
some more.
Yeah, I might have to make a storefront for people. Yes.
Yeah.
Have you had a look at the FTSE, by the way, because that's where I wanted to start from.
No, but I'll listen to you as you go over it. All right.
Okay.
All right.
We were looking at the possibility of a bigger Head and Shoulders like a long time ago, because we had a Head and Shoulders little top here.
Right.
But there are more formations here. For example, we were also looking at this ascending wedge.
Yeah.
We broke below it. We retested it. We're rolling over again. Then we also have this trend line, which we're testing at the moment. So,
it's heavy, buddy.
Yeah, it's heavy, and we are at very, very critical juncture, because at the very least, a break below here should take us to the confluence of the 23.6 and this very clearly defined support resistance zone. We had
a possible
highs
bigger Head and Shoulders top.
Yes. We had drawn this, so it can, of course, it can take a little bit more time to complete. I mean, it might go something like this and something like this, and then break lower. Okay, but as it seems, things are moving slowly, but in the direction we were looking at, and a break below, I would say 7,350 should give us a push to 7,100. So it's a process, but it's it's underway, and as long as we respect this high that we saw a couple of days ago, which is roughly at 7.5K, I think having our eyes set for more downside, is probably the way to go. Many technical formations, as I said, and most of them point to lower prices. Of course, nobody should forget that this has been a prolonged uptrend. It started with a big inverted Head and Shoulders pattern. We then went to a wedge. Also, you can define it as a channel. But one way or another, we've started breaking below, several support levels, and it seems that it might unravel further. So, having to do with stock indices, once again, I'm firstly looking at the FTSE is 1% down today, by the way. So, I'm first having a look at it, and then to the rest. Now, Blake has already covered, DAX. We have a pattern in play to it as well. For me, DAX today actually tested the upper zone of my first support, and it seems to be rebounding at the moment. We had drawn this. We were here in this correction. We said either lower from there or a rebound higher, and then move lower towards the zone. We rebounded a little bit higher than I expected. Then we resumed to the downside. Now we're retesting a first zone. The next support is at 11,800. was an important level for quite some time. We tested it as a resistance, again as a resistance, then a support, again as a support. The general zone, I mean, I'm not talking about a single level. So, you always have like little support resistance zones. And, if you notice, they quite often work very nicely in the charts as long as you know how to recognize them, which, isn't anything complicated. But, one more thing I'm looking at, and I know that Blake is looking at it as well, is the Nikkei. The Nikkei can also have multiple interpretations. One of them is an ascending wedge. Okay, there is no question about it. I was also monitoring the possibility of another ascending wedge. That's why I also had this probability, another test higher before breaking lower, which this one didn't materialize. But there is also a shorter term interpretation of a little triangle here. I haven't drawn it because it's quite clearly visible, but let me show you what I mean. It's also kind of a symmetrical triangle here in the short term, if you see. Okay, so plenty of formations here that soon enough we'll know if we're actually talking about a breakdown and a probable test of the 19,000 level, or perhaps, because that's also a possibility in this bigger wedge, there is also the possibility of one more push higher to shake out, everybody that is looking at it at the moment, believing that, this is going to be a great short, and then, a breakdown. So, this is something to watch. And since we're talking about the Nikkei, the USD yen played ball. It gave us, the move lower that we expected. The 12,000 level did not hold. Sorry, the 112th level did not hold. So now I'm looking at another probability as well, this being a triangle. Gregor talked about it as well. So we're talking about a more complex, if I zoom out, we might be talking about a more complex correction to this move higher. Okay.
Downwards, so, I think he said 109-ish, 110.
Yeah, and you can see that I extended this trend line here, Dale. So, this is now a scenario as well, right?
Yeah. Mm-hmm.
And in this case, what I want to see is, because for me this is an important level, I want to see again how this area is going to react, but this time after being tested, from below instead from above. So this 111.60 to 112 area remains important, and it more or less is now acting as a median level in this larger triangle. So, this is now an interpretation, and we need to see how this is going to work out. So I remain neutral and not bearish the USD yen, but this price action is obviously showing us that there is a more complicated pathway than initially thought. So we need to see how this is going to work out, and it might need time. It might need time. I mean, you have to be patient. I don't think this is the time to be outright bearish the pair, because if this triangle is actually playing out, we're closer to support than we are again at the resistance. Of course, in the short term, you can just play it with a 112 level in mind. So, for example, for another move lower without surpassing, the 112 level, and this might work actually. There is a risk reward to do that. But if you're looking at the bigger picture, I think you need to remain nimble, and that takes us, to the view in the yen pairs, because yes, they are moving lower, but I'm not really convinced that these moves will accelerate. And I'm not often doing this, but if we go to a 4-hour chart, I can show you what I mean. This is the pound yen. I had two zones in mind since before. I didn't redraw anything, during the past few days. So I had two zones in mind. One was this, in which I took profits to my short, and the second one was this, which we are testing, and this also, has a confluence with the 200 moving average on the 4-hour chart and this ascending trend line support, and we seem to be finding support here. So, this move can even, prove to be complete. I'm not saying that, you should be long at the moment. I'm saying that if you were short, you should perhaps consider of at least booking some. Okay.
If we take out that trend line, Steve, I know there were some targets all the way down towards 42, 41.50. It may have been Grega's count.
That's
so
a good
if
point.
we take that out, that would make it more likely. I didn't even see that channel before. So
yeah, I'm going to show you on the daily chart once we go back on the daily chart what are the targets afterwards. But let's go to the euro yen as well, on the 4-hour chart. I mean, and just look at this. This is the euro yen, okay, on a 4-hour chart. I'm even more skeptical in the euro yen simply because on the 4-hour chart, what I see here is a triangle for the time being. I mean, geometrically speaking, triangle is a very simple formation. We're getting higher lows, but lower highs at the same time. Usually, this is a formation that breaks to the direction of the trend, which means that if that is the case, we might easily see a new high here, okay, in the euro yen. I don't like it. I don't like the fact that we are unable to post a lower low. I mean, okay, yeah, we got rejected roughly from where we expected. Then we got rejected again because we said that we should at least see one more leg lower. I'll take you back to the daily chart. But again, we're failing to push to post a lower low, and that's worrying because this is for every candle that passes and we don't break this is more likely to prove being a triangle, and this is probably going to be resolved to the upside.
So if you were short from that surge up around 30.5, you'd be out here completely.
Yeah, I don't know. I don't like it. Look at this.
I mean, it's all right.
And even if we see a new low, then a simple ABC target would take us to 128.25 roughly. Okay. So the risks for a move higher, the way that price action is playing out, are decent. I mean, this is not a pair you want to be involved at the moment because it's slow, it's choppy. It has the potential of pushing higher once again. I think there are better opportunities if you want to be short. I'm simply saying that can prove to be like a 1, a 2, and now suddenly seeing an acceleration lower, and this proving to be a 3, which is a possibility. But from what I'm seeing at the moment, I'm very skeptical. The least to say. So if you're short, I'm not saying like quit, bail out, abandon your shorts, because there is still a chance that this will accelerate lower. But I'm telling you that from what I'm seeing, especially if you see a break above the recent high that we got 2 trading days ago, most probably that's done. It's all you got is that, and then you will see at least one more high. That's all I'm saying. So, you need to be nimble and you need to be careful here. Okay, let's have a look at the questions because, I didn't even have a look at them. I'm just, I started from the, I started from the FTSE, and this brought a thought of process that took us over a few pairs, but let's see what you guys and girls want to have a look at. If I'm bullish the pound and bearish FTSE, pound could cut. Okay, I've said that plenty of times and I'll repeat it once again. If I'm bullish the pound, if I had to be something the pound, I would be bullish. Yes. I'm not like outright bullish, and I'm not like, I think there are better buying opportunities out there. But as I've said plenty of times when I'm being asked, would I be bearish the pound from what I see technically speaking here? No, I wouldn't. Why would I be? We had a clean correction lower after testing with a 130 zone. Okay. Then we started moving higher. We respected 128 on the dip here. We had an ABC correction. We moved to new highs. We are more or less respecting this 130 zone. I mean, we've been penetrating below it on an intraday basis, but it's still holding. So, you know, this is a slow process, but is it a bearish one? No, it's not. I mean, as long as we hold this 128 zone, I find no reason that somebody should be bearish. So yes, that helps the bearish FTSE bias, the fact that I don't see any bearish setup in the cable. Euro Swiss short. Okay, that's an interesting question. In a pair that I have been monitoring, I've been showing it here at least once per week. And the answer is yes, that could prove to be the case, but I have to ask you why. I mean, what is your technical level or your trigger going to be? I'm seeing a break higher from this channel after a long time. Of course, somebody could say that a retest of this zone here, you know, could provide a, you know, a bearish drive. For the time being, this looks to me more like a consolidation. Of course, those two candles, you know, are strong ones, but you know, as long as we remain above 109.60, 70, I don't see a bearish setup in the Euro Swiss, actually. So, you know, I'm more inclined to believe that, you know, as things remain calm, why not get something like that? So, no, I'm not seeing, I'm seeing the potential of a move lower, but I'm not seeing a bearish setup, actually. Okay, I've been warning that this thing might be breaking higher since some time ago, and you know, if I had to buy or sell it, I would be a buyer actually. Not up here at the moment, but at a pullback, you know, I would probably be a buyer. Not my thing to do though, because as I've said, I prefer tickers that move faster, that give you you know, a signal that you're either right or wrong, you know, quite sooner, so you don't have to commit capital in being in a position that does like almost nothing or does things like in a very, very slow pace.
Sounds like you should start trading cryptos.
No, because that's at
you want things to happen fast. There you go.
Yeah, but that's at the complete other
the other
side
extreme
of the spectrum.
Okay.
Yes. I mean, having to do with Europound, you mentioned it before. I remain short, as I had told you last week.
Oh, I remember that.
Yeah, for me, a move above 0.90, you know, would call the end to it. I mean, I would book, you know, a loss at it. For the time being, you know, I remain short, very skeptical. I was expecting that there could be a possibility of another move higher, but I would really not want to see anything more. I mean, I'm actually now going to put an actual stop to it, just above this high. Because I really have no more tolerance. I'm not speaking from a financial position. I'm speaking of a technical perspective for another high. So I
know a guy who used mental stops, Steve, and he told me that his first stop was a mental institution.
That's a good one.
Oh, I'm talking about myself. Oh, okay. No, go ahead, buddy.
Do you think that Euro Aussie made the reversal to the upside last Thursday and the correction is a good buying opportunity? And the second person, that was Karad and Said, also asking about the same thing. Okay, so let's have a look at the Euro Aussie because it's going to make two people happy at the same time. I mean, That's a win-win situation, right?
Yeah, Doublemint gum.
Okay. What do I think about the euro, Ozzy? I'm skeptical, I have to say. Let me give you the good aspect. We reversed higher, okay, from the ABC, the equality level, and a zone I had already marked as an important support zone. So, you know, that was a very important. We also posted an outside white candle. So that was a very, very nice reversal candle. There's no question about it. There is even the potential that this thing is going to lead now to new highs. Do I have confirmation yet about it? No, but I can tell you one thing. If you like it to the upside, you know where your risk is, and that's something very important. Okay, you don't want to see a new low below here, because then the structure is going to completely change. Okay, so there is the potential that this has found the bottom. In this case, today's pullback is a buying opportunity. There is no guarantee that this was a bottom, but you can't ask more than a very clearly defined risk-reward ratio, okay, and some confluence that tells you that it might be going higher. So, you know, I'm cautiously constructive. That's what I have to tell you.
That's a good one.
Yeah.
You know what I am? You know what I am?
What?
Strongly neutral.
Oh, strongly neutral. Okay. By the way, EuroNOK and EuroCAD, since we've been looking at them, seem to want to move lower once again, which is nice. Okay. I'm already, you know, light. You know, and EuroCAD looks better than the rest, to be honest. This looks like another bear flag. So it might actually end up, you know, filling our initial target and the confluence here of, you know, filling the gap, the 200 EMA, the equality target at 144.50. Let's have a look at the Euro Kiwi as well. And then there is another pair I want us to have a look at. I forgot to mention it last week, but I think it looks interesting. I know that most of you won't trade it. It's the Euro MXN, actually. Okay, Euro Kiwi. Euro Kiwi, you know, from all the Euro crosses, probably the less clear at the moment. So just, you know, trade something else. But the Euro MXN, I think is, you know, is clearly in a triangle. Okay. So triangles often get resolved to the downside, and that can produce a trading opportunity here. Okay. So I would say that as long as we remain below, let's call it roughly 21, that's not a bad trade. Okay. If I'm still short the Nasdaq, that's a good question. The answer is yes, but let me warn you about it. I am still short the Nasdaq. I do see this like a triangle now, okay, which means that I'm expecting my trade to get out of the money. Unless we see some acceleration imminently, because I have no problem telling you that I have a trade and I believe that the odds are against me at the moment. But I need to remind you here that I explicitly said since the beginning that I'm fine in this trade to be out of the money and add higher. So what I'm seeing here, if we need to rework this chart, what I'm seeing here is that there is the potential of actually not going lower yet, but actually doing something like this. Okay. So these are the two potentials, and I'm okay with that. But let me be clear. The chances of a move lower, since both of the times that we've done that, on Friday and on Thursday, we got buyers, and we left behind those wicks, this looks clearly like a bull flag to me, and or a triangle, and that would be very nicely fitting the possibility of an 1, 2, 3, 4, and a little 5. I'm saying a little 5 because simply this was a little 1. So you see here, if that was the low on the Friday's low, then a projection would be exactly at the 127.2 at 5,990. We actually have it coming at 5,993. That's 3 handles above. Okay, I already said that this is a light position here. That's 50% of my position. And I said that I have no problem adding higher. So I'm identifying this, as a possible trade that is going to be against me for a little while, and I'm okay with that. If I wasn't okay with that, I would now book, I'm like 14 handles in the money. I would book like some negligible profits and, just, short it again. But I don't want it to roll over, which it is a possibility. In my opinion, now it's like 30% of rolling over from here, 70% of, resuming higher. So I don't want it to roll over and have no position because I really believe that this is going to roll over. So I'm going to stick to it and add closer to this point. Okay, so be warned about it. So that's, my exact, and thank you for reminding me actually to talk about the Nasdaq position. So I'm sticking with it, but keep in mind we might go higher first. Aussie, Kiwi, USD ruble, Euro ruble.
The bond, did you cover the bond?
Yeah, that's why I'm reading everything. Aussie, USD. Okay, let's take them one by one. Okay, Aussie, USD. We'll see Aussie, we'll see Kiwi, and then I'm going to go to the rest of the questions. Okay, Aussie, USD. That's what I was seeing here, and we might be over with it. I mean, I said a move lower and then a new high. Okay, this might have been enough, it might, or we might get another leg lower from here. So let me redraw now, or we might get this. Okay, so I'm seeing something like this or something like this, but that's going to be the end of it. That's going to be the end of it temporarily. Okay, so I think one more thrust higher, either from this low that we found here or from a little bit lower here, for example, to retest this little zone, this little consolidation, and then we might see a bigger correction down to this area, to the breakout area. Okay, so that's what I'm seeing. This was an overthrow here. I'm seeing more or less the same luck for Kiwi. Okay, lower from here, higher once more perhaps, then again a bigger retracement perhaps to this level or to this level. So bottom line, don't be short those pairs yet, but on the other hand, you definitely should not establish fresh long positions from here. I think you will get rather soon a better opportunity to be long if you want to be long those pairs. Okay. So now let's go to the bond that Luca is asking for, and then we're going to go to the other crosses that our friends asked about, the ruble, the Aussie Kiwi, etc. Oh, actually, let's go over the Aussie Kiwi first, since we were talking about these pairs, and then we'll. Okay, the Aussie Kiwi. Firefox is not playing ball at the moment, but it will. Okay, the Aussie Kiwi. We saw it on the weekly chart as well. This was a huge rejection up there. And the reason I don't want to be engaged again to the upside, let me put it on the weekly for whoever wasn't here, I think on Friday I showed it, is that I honestly don't like at all this candle on the weekly, at all. I don't like it at all. this rebound is nice, and somebody can say easily that, okay, fine, we didn't make a new, a lower low, but I warned when we saw this rejection that I'm taking my profits below 1074. I did so, and something, I'm gonna be looking to get involved again only if I see the bullish price action getting strong again. Perhaps I'm going to take advantage of another break higher and the retest of this zone, or a break higher from this descending trend line and the retest of it. For the time being, I'm gonna remain flat. Already had one successful trade here, and I'm not seeing something I love yet. So we can keep monitoring it, of course, and see what happens from there. I have nothing well defined to say at the moment. Okay, let's go to the Bund. Okay, this was a predictable move in the Bund, because when it actually did this, we said, okay, it's either going to roll over from here, exactly here, or going to produce, you see, we drew it exactly like this, or going to produce, a second move higher, but the critical zone is actually this one that we're testing at the moment. This is the confluence of an A, B, C. It's also a horizontal support zone. Support resistance zone. In this case, we're testing it as the resistance. Just a little bit above it, we have the 50%. So I have to say that for the Bund, we have now entered the zone that we need to see a reaction to the downside. So it's also the 200 DMA here, the 50 DMA. I mean, I'm very interested to see what's going to happen from here. I'm not committed. I don't have a position here, but I'm going to tell you one thing. If I see a big rejection in this area, I'm going to be selling it, because I like this move lower, and I will very much like this area for a rejection. So, I'm monitoring this. I need a trigger. What's that trigger going to be? A big candlestick reversal, shooting star, an outside day, or whatever the hell the market decides to produce for us. And if I see something like that, given the prior price action and the levels, I will be believing it as a technical event. So I'm gonna be selling. Okay, that's what I see here, Luca. And since we are at it, let's have a look at the treasuries as well, the 10-year. Let me add the 61.8 here. Okay, we're almost at 61.8, and this is also a critical level, because we saw this break below the ascending wedge, but we definitely don't want to see something more than that. Okay, I mean, we're almost at it, and we don't want to see a break higher, because then the whole bearish thesis gets much harder to play out. So to actually trust the break lower in the treasuries, that actually the fact that it might continue lower after this complex consolidation / correction higher, we need to see a rejection, and we need to see it imminently. Okay. So now let's go to the USD ruble, which we've checked plenty of times together. And this is what I see here. Okay. Whoop, there we go. Okay, we held this zone. That's very important for the bullish side. The fact that we held this zone is very, very important. As long as that's the case, I remain constructive. Beware of this bearish possibility to see something like this, because then you have a head and shoulders formation. But unless we see something like this, okay, I remain constructive, and I think we can easily go all the way to here to at least test the 23.6 of this whole move lower. Okay, now let's have a look at the euro ruble. I like you. Who trades the euro ruble? I really like you. These pairs very often create opportunities.
Vladimir Putin.
Yes. We had talked about the euro ruble when we broke above it here. I think that this move higher is now very mature, and you should be very careful for a pullback. Okay, but this is bullish. This is a bullish break. So if you were long, that was an awesome trade. We had pinpointed it some time ago, but you should be nimble now, because I see the possibility that we will soon get some kind of a pullback, in which case, for whoever isn't involved, you know, around 65, I think we're going to have another buying opportunity if we get there. Okay.
Thank you, Steve.
Okay, enjoy your interview. Whoever doesn't know who Mark Newton is, I think you should really stick around and find out. I'm going to definitely be listening into the interview. Enjoy the interview, Dale, and thanks for having us.
Great analysis, Steve. And you know what? Kudos to you for using a literary device called alliteration when you said cautiously constructive. That's using two words that sound the same. Constructively. Cautiously, it's alliteration. So I learned that in college. All right. So I'm going to make Mark the presenter now. Welcome back to Face, Mark. So glad that you're here. What's going on here? Mark Newton. Make presenter. There we go. Everyone, welcome Mark Newton to our community. This is a return interview for Mark. He was on here in April. Hi, Mark. How you doing, buddy? Waiting to hear your voice. Looking at all your DeMark numbers here. How's your microphone?
Hi there, Dale. Can you hear me now?
Got you, Mark. Yes, Mark.
Okay, great.
Thanks so much for stepping up and coming in here today. I thought it would be a great time because kudos to you. When you were here in April, you said there was really nothing to stand in the way of further market strength, that you were sanguine, but that there were going to be some changes. See, I remember everyone's trades and everyone's interviews occurring in July and August. And then I noticed a tweet by Andy Nyquist of See It Market that you published an article that addressed exactly that. So welcome back, my friend.
Thank you very much. I appreciate you having me. Yeah, things, there's still, you know, a few things that suggest that markets can in fact go higher, but increasingly, you know, we're starting to see a couple things that are a little bit problematic that could spell at least a period of near-term weakness. And so, you know, it might be important to talk about those with regards just to equity.
Yeah, maybe you could go over that piece that you wrote for See It Market and what you saw as, you know, I believe that some problems were developing was kind of the bullet point of the article.
Well, the first and foremost, you know, most people look at trends, and myself as a technician, nothing has changed with regards to that. Obviously, trends have still been quite constructive with regards to most U.S. indices and sectors. I think globally, things have gotten a bit stretched of late. Part of my point just rested on the fact that when you look at things like the Bloomberg World Index, you'd gotten very overbought, very stretched. You're now at levels where you do see some signs of counter trend sells based on DeMark. And just looking at this trend since the latter part of 2016 or the election, the run has been nearly uninterrupted. But we're at levels now where potentially we could see some back and filling here, a little bit of consolidation globally. And so my thinking is that that also could affect U.S. stocks as well. Most of it has affected Europe. We have seen most of Europe sell off since peaking out in mid-May. And so I think that's
something else you
important.
talked about, Mark. You know, everyone was, you know, moving their money overseas, especially Europe. And I
Yep.
believe, and I remember you saying that you thought it was time for that trade to move the other way. And the DAX has been really the one under pressure, mainly due to, you know, what's happening with the euro. But that was another great call.
Correct.
When everyone was going into Europe. You said you thought that trade was the other, it could come in, and that's exactly.
Well, we saw sentiment get to pretty bullish extremes with regards to Europe as well as on the euro, and so, you know, we have seen a little bit of weakness thus far in the DAX. My thinking is that it really is near make or break here. We really need to show signs of finding support and holding pretty quickly. We can't really afford to have, you know, the DAX get under 12,000, which would really kick off a larger period of weakness, I think, for Europe and potentially the U.S. Just to get back to your original question, I think the key things to watch for most investors and traders with regards to U.S. stocks are a couple things, and one is that we had gotten fairly overbought. We saw that in the Bloomberg World Index I showed, as well as U.S. Markets as well, and momentum really has not followed this move to new highs of late, because we were largely sideways since the early part of June, late May, early June. And so it's tougher to see that on a weekly chart, but this grinding period, we saw a spike in momentum in March, and that really has not been bested. And so that's a little bit of a concern, this little growing negative divergence per se with regards to weekly charts. The daily has gotten fairly stretched. Go ahead.
What is that momentum indicator that you use down there? Looks like it's two colors. Two lines.
Well, this is just a simple MACD, MACD, moving average convergence divergence. So it's not a really rocket science. A lot of what I use this for is just for divergences. You know, the crossovers, in my opinion and experience, have limited success for causing turns. It's more just for purposes of trend following and making sure the trend's on your side if you're entering a position.
How about
we had gotten fairly stretched, but, you know, since S&P went from what 2,400 to 2,480 in a very short period of time, the first 3 months, there's 3 weeks of this month, and now we're entering seasonally a more negative time. Things have gotten overbought. You see a little bit of negative divergence. The real key, though, is going to be technology, and that's something to watch, because we had a little bit of shakiness in things like the XLK. This is just obviously a very concentrated ETF for technology that holds mostly large cap tech, but most of the other technology indices really mirror this. So I think it's important to look that this pattern, in fact, did fail early on. Many thought this was just a mini little head and shoulders of sorts. We broke down, but really didn't accelerate, held for a few days, and then blasted right back up through the highs. And so now we're up right by this area near early June highs. And so given that this sector represents 22% of the S&P, it is very important in terms of what tech does. And, you know, Google's earnings out today, a couple things that, you know, if we show signs of pushing back up to new highs, and that means likely that this whole pullback can be delayed. But based on, you know, some of the proprietary cycles that I run that gave turns in early April and also early June, the next period that was on my radar was really July the 20th through the 23rd, and obviously over the weekend, you know, today and Tuesday could be included in that. But we really need to turn down quickly if we're going to do so. You know, we've stalled out over the last couple of days. That's not necessarily all that bearish, but there are things such as technology weakness, and really the weakness we've seen lately just in things like the industrials and the XLI, which have truly started to show a lot more signs of rolling over of late, with the transport weakness. And if we pull up that chart, you see that, you know, we did in fact break at least a 1 month trend. We've seen a little bit of weakness in the rails of sorts of late. You did see some counter trend signals there. But of course, this is short term only. I mean, when you pull, you know, the longer term charts of this are still pretty resilient. So everybody's looking for the top and looking at things like implied volatility being under 10 as being a concern for the market. I think many times this low volatility can tend to persist. And so,
well, it has.
You know, what I'd like to see for a real bearish standpoint is to see signs of credit spreads really starting to widen out, and those have been pretty resilient of late. So I'm looking really at the.
Where do
Go
you
ahead.
look for that, the credit spreads, to know whether they're coming in or widening out? What instruments?
Well, I just use a simple gauge of really looking at the ETFs with regards
HYG?
to HYG versus the LQD versus for the investment grade. But really, it's tougher with regards to using these just because of the flows, supply and demand within credit. A lot of these will mirror what's happening sometimes in treasury yields themselves. So it's only a real basic picture and doesn't give you really the whole, the whole picture. So some people will look at, various different, spreads and different gauges, but really it's not rocket science. It's certainly not perfected. I mean, this really blew out back in 2008, starting back in October, and credit spreads widened pretty materially, and then they've been compressed. So we've seen a little bit of a lift, slowly but surely, and crude having pulled back a little bit really didn't cause much deterioration at all in things like the HYG or JNK. So the bands have been growing lower, and now we're at an area where we do have TD sequential 13 cells on the JNK. So we'll see, in fact, if we can start to roll over. Part of my thesis was really that crude should start to move a little bit lower, that the US dollar is going to bottom out, at least on a short-term basis this week or next week. And so you could see some weakness in the commodities, and if crude starts to affect high yield, then that would be a bigger piece of the puzzle. But my cycles, aside from here, pinpoint a turn in mid-August as well as late September. And so I was thinking potentially you could see a high here and a pullback into August, into mid-month that would mark a low, and then a rally into late September. And so we'll see. If we get past the next week and we have not peaked yet, then that means we're probably going to rise into that central band of mid-August and then peak then, which would be a larger peak, in my opinion.
Maybe
but, we just need to.
Maybe the market peaks in late August around the total solar eclipse. I think it's the 21st, 22nd.
Yeah, there's a lot of time cycles that pinpoint that exact time, and so that's important for those that
that's
study
the first eclipse.
any sort of astro cycles. I mean, there are a few things that also line up there that really have some importance that have coincided with really peaks and troughs in equities over the last couple of years. That's really beyond the scope of what I wanted to get into here in this discussion, but it's something that I keep tabs on a lot of time-based cycles, and do think that they can have some significance, particularly when price, of course, starts to react, which is really the key thing. It's tough to put too much stock into a lot of things that might cause equities to turn down. We all know that earnings really have very little power in that regard. The whole macro themes are really, worthless. A lot of this DC drama that's causing people to be on edge really has served to continue to cause equities to move higher. So none of that really works. A lot of it is just sentiment and cycles. And so the sentiment arguably has gotten a little more constructive with regards to institutional investors, but with retail investors, I would argue, there's still a lot of skepticism in there, a lot of frustration, and there's certainly no real signs of ebullience like you saw in 07 or 2000 that would say, okay, we're at a peak. So it's more of a muted type, begrudgingly bullish type stance where people are gradually getting more and more optimistic, and we're seeing those overweights reflected in a lot of the portfolio managers' data with having, being long to stocks, but yet still an underweight to U.S. stocks, and so that's interesting. But the cash levels, might be something to watch there in the weeks ahead. So my thesis of being negative, and I've been positive on the market really for the last few months, but I said, we're in a window now where the cycles could turn. You have XLK right up near former highs. So technology, if we start to stall out, or if we have negative earnings by a couple of these, that could be important. Momentum has obviously slipped in the tech sector of late based on this June minor little sell-off, which really didn't see much follow-through, but tech is going to be a key piece of the puzzle. The divergences, but for me, it's all about the price action, and I really want to see to be truly bearish. I mean, you need to see signs of the rally from November lows being broken, as well as the lows from last February, and so that's going to take at least a move down under 2,400 at a minimum, and really down under almost down near
21.
23.80 to show, okay, that we're really starting to peak out. So for me, we're in the window for a short-term peak. Whether it turns into a large one or not, we'll wait and see. It's not.
Right.
That's never the way I've tried to manage my own money or instruct others, is to make these long-term grandiose projections that might or might not work out. You really have to follow the price action and stay on top of it, and that's really the key to success, in my view.
So as Amazon goes, most likely will be as the technology index goes, and Amazon made a new high. I don't think it's confirming, but there's Amazon.
Yeah, what's interesting, so I put together a little basket of the so-called FANG names, and I think it's typically wise to see how this is doing, and you see that this started to dip, and we really didn't get much follow through. We're still pretty extended. We did get counter trend sells back in early June on the FANG space.
Right.
Momentum is barely positive, but we've sort of, things like MACD have sort of fish hooked a bit, and often that can be problematic where the trend goes higher, but yet we're still struggling to make highs of momentum, given that we're so stretched above this longer term trend just from back in 2015. So we could certainly afford to give some back, but yeah, I look at stocks like Facebook or Google, which today having earnings, and this is sort of an interesting potential bellwether that needs to be looked at pretty carefully. And so the daily charts argue that this stock is up against pretty key levels. We made sell setups. So this is very similar to what's happening in the XLK. So it's almost a mirror image of what's happening. So you look at Microsoft, you look at Facebook and Google and Apple, and those will give you a feel for, obviously the larger tech sector, the way that most people tend to think about technology.
So let's talk about where retail was right, and a lot of people were fading them. They were long the euro all the way up. I'm interested in your view in the Dixie. You said you're looking for some type of short-term low coming in here in the next week or so.
Yes.
Do you have any levels that you're looking at? And do you think that it will just be, after this type of decline, just another bear market rally, and the dollar trend has changed from a secular bull to a secular bear?
Yeah, okay, let's address these first things first. So I want to look at the euro, obviously, given that that's such a large component of the DXY, and some of this is based on the combination of DeMark signals along with sentiment. And so we're really on the window of being within 1 to 2 days of what's called a 9-13-9, where we have a completed TD sequential and combo pattern, and then we have a sell setup, which is approaching with 9 consecutive closes above the close from 4 days prior. And so when that happens, typically you tend to get a reaction. Now, we have bested the highs from back in 2016, but as you know, we still have the previous peaks from back in 2015 that we're sort of wrestling with right near 117, at least on an intraday level from back in August. So the broader picture and how this lines up is you look at, the breakout was pretty constructive. It could have gone one way or the other. I think the last time we spoke, we were up against good levels, and I wasn't really all that sure. I wanted to see proof, and obviously this sort of changed things for the better with regards to euro versus the dollar. And so now we've gotten a little stretched in the short run. You see, classical technical indicators having reached overbought levels. Based on the daily chart alone, I think that we're in the window here in the next couple of days for at least a short-term pullback to right near probably 114.5 or so, and we just haven't seen that bigger breakdown, and we need to see that to really turn truly negative on the euro, or vice versa, being positive on Dixie, to think that we get this large move. Right now, a lot of this just suggests that we're going to see near-term exhaustion sometime this week and give a little back. So I don't mind being negative here at 116.38, risking, up to 117, spot 25, and thinking that we start to sell off and get down and can give back a little right down to, an area towards the lower part of this Bollinger, which would be a decent area, I think. That, but, you see a couple different things as part of this process. One that is interesting is the fact that dollar yen is also down at a level where the dollar could start to mark some type of a low and really start to rally. The issue, though, is when you look at the market indicators, that this is now through this so-called TDST. We've got the 9 count. If that's perfected, then that's going to drive it even further. But I do think we're in the band where the dollar can turn, and you know, as the dollar turns against yen, against euro, you know, that should mark at least some sort of a tradable type low in the dollar. As to your larger question, I was thinking that we'd actually start to snap back and could see a final move higher in the dollar before the peak that you know, met this year's highs in the dollar overall. We are in this 16.5-year cycle where, since the last time the dollar really peaked out in you know, the early 2001, that we are in the window now for another peak in the dollar. And so you know, we take a look at longer term charts like DXY, I'm gaining conviction that you know, this potentially could have been the larger peak that we were looking for back in December. And then we could just see you know, rallies might prove brief, and we have just a further deterioration in the US dollar overall. So you could see a little bit of a snapback. We have gotten overdone to the downside. Larger pattern was pretty constructive on this up until we really broke down, you know, right down here in early May. And that's really a time when everybody from a trend following perspective had to realize that something in fact had changed. You can consolidate a bit, but once you see this break that happened in mid-May, you realize that really all bets are off and you can throw this pattern out the window. And so now, you know, you can have a brief pullback, and, you know, you could see greater support for the DXY down near 92. So now we have, you know, maybe a short-term blip and rally, and then maybe this setup count completes, and we have a larger decline in the dollar down to, which would really fit in with, you know, the seasonal upswing in the metals potentially from August into October, and then maybe make a larger low in the dollar there. But I'm a little bit negative now on commodities being gold, silver, precious metals, along with oil. I think that we're in a window where those likely start to turn down, at least in the short run. And you know, gold has had a decent little lift for a few weeks' time after this break, and we're actually in a window now where you know, gold likely could start to see, you know, a little bit of resistance come in. Pattern has been largely flat to range bound. Now we're up against the highs of this Bollinger. You have a number of different forces that suggest that, you know, dollar starts to rally. You also have a window for treasury yields to turn back up as well. So the combination of those would be truly bad for the dollar. So I don't mind being out of all, I'm sorry, for gold. So I don't mean I don't mind being out of gold longs here and considering going the other way and just waiting for this confirmation as to when to press you know, shorts in gold and gold stocks. But gold stocks have been the one thing that really have not lined up with gold.
No, lagged. They've done nothing.
Yeah, they've been horrendous. So now you're at an area where I think it's a decent risk reward short for things like gold mining stocks, things like the GDX, at least in the near term, that we start to pull back. The base metals are a different story, and you have this whole infrastructure reflation theme where you've seen the steels and the iron ore stocks, and they've started to look actually quite constructive. So maybe this proves just short-term in nature for the matter of maybe 3 to 5 weeks. You see a little bit of a pullback in gold stocks, and that gives you a chance to buy, you know, as the dollar sells off further down towards May lows of last year, and that could help gold potentially into the fall. But, you know, for right now, I'm willing to take a stand and going against the metals trade and thinking the dollar is close to at least a short-term bottom where the euro can sell off a little bit versus the dollar.
Okay, well, I interviewed Raul Paul a few weeks ago, and he uses DeMark too. And I don't know if it was a weekly chart or not, but you know, he's similarly looking for, you know, he's a huge dollar bull, and he's similarly looking for an important low in the dollar to come up with a DeMark signal, you know, maybe around that 92 level. You know, I think they'll take out the 92 bulls first, but can you still make a long-term bull case based upon DeMark once we take out 92? And then the other question is, if we're finally, you know, I don't know when people are going to finally say, well, the bull market and the dollar is dead, and, you know, maybe we're heading into the 80s or 70s or something like that. But do you think, Mark, that part of what's going on You know, I heard someone say that the dollar normally suffers under Republican administrations. I think it was Howard Friend. He doesn't know why, but it does. That eventually dollar weakness is going to be, especially if it continues and is pervasive, that makes yields go up, not because of economic growth, but just to slow down the flow out of the dollar into other currencies. And then that's the bubble, that's the pin that pops the equity bubble, are higher yields.
Well, we've certainly seen a little bit of difference in how yields have moved with the S&P since March. I think last year we saw, you know, every time yields would move up, stocks would move up with the financials, and this year has been a little bit trickier with yields starting to sell off towards, you know, from March through June, and you know, equities certainly did not go lower. So, you know, I still tend to be, you know, so here's the dog to answer your first question. So, you know, the mark, at least on a monthly basis, you know, we never did see these highs. So we're back in April. I thought, well, if we hold here and we could start to push up with one more move, we could get, you know, a lot of DeMark highs right at the highs of the dollar, and then we'd sell off. In fact, it's gone the opposite way. So the break in May was important. Now we're on a, you know, a TD 5 count, which would mean another 4 months potentially, which isn't going to likely materialize if we see any sort of rally in the next month. So, you know, from a DeMark perspective, it's tough to put a real low.
The monthly says another 4 months of weakness because of this.
The monthly says that we would need to see at least 3 months, potentially 4, before we get any sort of buy setup. And so you look back over the years, you have had, you know, sell setups back in 2005, you saw buy setups right at the lows in 2011, you saw a brief period here. There's no saying that this, in other words, the monthly chart is inconclusive, and it's tough to make prognostications just based on this being a 5 on a setup count and saying we need to go down 5 more months. That just doesn't hold water. The real key is when it gets closer to a 9 count. On a weekly basis, I think the point he was mentioning is that if you have another, you know, 2 to 3 weeks down on the weekly, that you could form, you know, what's called a, you know, a buy setup right down near these lows. The problem is that when you take things like this former area of support that's now been perfected for those that study the mark, that really nullifies this setup, and everything. It historically means that you have to go towards a full countdown before you see any sort of low. So I think the dollar downtrend from last December is still very much in force. If I can sort of simplify my comments and say that I do expect a brief rally in the next 3 to 5 weeks in the dollar, but that should be sold, and think that dollar weakness likely persists over the next few months.
What kind of magnitude of a bounce would you expect? That wasn't much that you were looking for in euro, so it's probably not much you're looking for in dollar either.
Well, I mean, just looking at just basic trends, you want to see at least some evidence of some of these trends being broken to claim that, you know, we're going to start a new a rally. The momentum has been so sharply to the negative here. So I mean, if the,
so it's a rally to sell.
Gets up to maybe 96 at the most. I mean, I think and that's probably optimistic, but initially I'll take my cues from just the daily chart and try to see, you know, first evidence that trends are being broken here, and so that's going to lead us, you know, right up a little bit over 95, thinking that, you know, we'd have to almost bottom sometime right away and start to push up. And if we take out the highs from last week, 95.16, that would be very constructive, as well as what I view as this other wave down, which ended back on the 30th of June, so 95.47. So those are the first 2 key areas, is right near last week's highs, along with the lows from late June. Getting above that would be a little more constructive, and then you face really resistance up near these lows from the spring, which fit in with the weekly chart. So, you know, we do have a window here, but it's, you know,
it's just a crack in the window. It's just opening the window a little bit for a little pop in the dollar.
That's exactly right. I think there's a brief window for a rally, but I think the dollar sell-off likely is going to continue. That fits in with the POTUS agenda and what the administration wants. Not that they have any real control or really can do a whole lot.
When does the debt ceiling become an issue? We weren't sure. When's the debt ceiling come up again in Congress? Do you know?
That's a great question. That's not something that's that I study a whole lot. That I really care about being a technician, unfortunately. But I think
October.
Well, we'll see with regards to healthcare reform if we get any sort of anything out of this, and then on to tax reform. I think if anything, most people realize that tax reform can't happen. It'll be probably a tax cut, if anything, and that the deficit. We'll see how that shakes out. I don't have any specific dates for you as to what I think will be important. Yeah.
Why don't you show your website and your service so that people besides Twitter, they can get a hold of you at Mark Newton, is it CMT at the end of the Twitter handle?
Mark Newton CMT is the one that's public. I do have a private Twitter feed that for clients. It's under Newton Advisors, where for those that like stock-specific information, I give a lot more info on that. The website is under newtonadvisor.com. So it is So this is a website that I created last year. So for those that do not know me, I formerly ran technical analysis for Morgan Stanley. I also worked at Diamondback Capital Management prior to 2011. So I have I've been in the technical analysis field, in the financials sector for the last 20 odd years on both the buy and the sell side, and have done technicals. But I run really just an advisory service at this point, talking with institutions and retail. I've opened it up to really everybody, trying to really help people to navigate the market more on a tactical, shorter term time frame than maybe a lot of technicians out there. So I'm looking at really the changes in sector rotation that can help people make money over the next 3 to 5 weeks. And I really take a global macro view and looking at commodities and currencies and treasuries and equities, and really not just look at stocks that'll make you money. Though, I have a long short list that I came out with back in January on the 9th that is now up 49% through Friday. So that is 5 longs and 5 shorts. So I have had some success in some of the recommendations, and I came out with a recent portfolio called Newton's 9, which I am happy to forward to anybody if they have interest. So my website is at newtonadvisor.com, and my email is at info@newtonadvisor.com, where you can reach me there as well. So I'd welcome everybody to check out the website, and if I can be of help to you, I offer packages for institutions, and I work with, I at least offer my work to retail, but that doesn't include any real tailored, work that I typically give institutions. I typically don't
in
speak
my extremely accurate and humble opinion, you're one of the best out there, Mark.
Thank you, Dale. That means a lot. I appreciate your support and inviting me to the show. I'm happy to join whenever you guys will have me.
Thank you so much, Mark. May dollar bills and gold bullion and euros rain down on you, and why don't we get back together in the fourth quarter and see what's happening then.
That'd be wonderful. Have a great rest of the summer, and thank you and everybody for tuning in. I appreciate it.
All right, Mark. Everyone thank Mark Newton and follow him. And also, isn't that great? 49% on 5 longs, 5 shorts. So I want to thank everyone, Blake and Steve and all of you out there. Great questions today. And before you leave, don't forget to click the link to become a subscriber. Risk $1. Probably made more than that being long the peso from last week on Blake's call. And I'll see everyone for Turnaround Tuesday. Good hunting, and most of all, don't just count your pips, count your blessings. I'll see you, my trading warrior brothers and sisters. Enjoy your summer day.
Thank you very much, Dale. Bye-bye.
All right, Mark.